So good evening, everyone, and welcome to yet another episode of a new series that we have launched, or new initiative, in fact, we have launched, Your Market Navigator. Under this initiative of Your Market Navigator, we intend to bring you some of the experts, either mostly internal experts are like our sector analysts, fund managers, CIOs, and also periodically even the external speakers and experts on various subjects, including markets and market strategies. Under this initiative, we have had two episodes so far. We had our banking analyst and consumption analyst kind of cover their two respective sectors over the last 2 weeks. Today we have Dhaval Shah, who is a fund manager for our ABSL Pharma fund, and he is also co-managing some of our hybrid funds, including equity hybrid 95, regular savings fund, and equity savings fund. So very happy to have Dhaval with us today, and we'll be in interaction on the Pharma fund. And essentially, we are just kind of going to be in interaction on three different areas. One will cover Pharma fund in depth in terms of the prospects, valuation, earnings growth, etc. In second part of the conversation, we will cover the most important thing that you all would be interested in, that is the Pharma fund's portfolio composition, topics, etc., and also the performance part of it, because we have completed we've celebrated first birthday of our Pharma fund last month. So we'll just talk a little bit about our absolute performance history and relative performance compared to the peer group and the benchmark in the second part of the conversation. In the third part of the conversation, we'll also touch upon some of the aspects like on the asset allocation of the hybrid funds that Dhaval is co-managing. So that's going to be the composition of our conversation, or the three components of our conversation today. And meanwhile, if you have any query, please put in your questions under Q&A section, and we'll take your questions and intend to cover as many questions as we can in the remaining second half of this session. So Dhaval, welcome to this new initiative.
Pleasure.
And let me ask you one question, which which all of us are interested in, not only as market participant or market observers, whether as an investor, analyst, or partners, but also as how the population would be of the world would be interested in knowing this thing, and that is, when are we really, how close are we in terms of finding a COVID vaccine? And as you all know, India supplies over 50% of global demand for vaccine. In this environment, how close you think any of the Indian companies is in terms of finding and providing the first COVID vaccine? So your thoughts on that before we really plunge into our sector conversation.
Sure. So, based on whatever readings we've had over the last few months, in fact, developments on the vaccine end has been far more better than, what we're trying to look at in finding a medical solution or a tablet for the overall disease that we're trying to look at. In fact, globally, there are 4 guys who are gunning for this, in terms of the timeline. They have said that the data should start reading out by, October starting, and till January, you will find a lot of data which comes out. So incidentally, a vaccine goes through a number of phases. So phase 1 and phase 2, where the trial is on limited number of people, the data has been encouraging that there is an antibody development. It's a 2-phase vaccine. First one, the dose that you take, after 28 to 30 days, you need to take the second dose, and after which it actually becomes effective. For there to 59 days, whatever data was available, all of them had antibodies developed, which were able to fight, coronavirus properly. So to that extent, there is a lot of hope that, things will actually roll on well. Now, majority of these successful vaccines, be it from Pfizer, Moderna, AstraZeneca, are all getting into phase 3 trial, which is where they will be trying on 30,000 plus people across, various ethnicities, in terms of, the skin color and, the age group profiling, etc., to say that it works across, the world that we're trying to look at. Meanwhile, they have already started manufacturing it in the belief that, the 1,000 people data is suggesting that there is efficacy. It's worth manufacturing this, and if the final data which comes out starting October till December, if the data is good, then immediately by January or so, the world will receive the first dose of vaccines. Our assessment is that there will be couple of vaccines which will come out, and each one will try to better the previous one by adding more scientific color to the whole evaluation process. And that is where we will have a series of vaccine launches starting from January that we should be hoping at. And that is frankly where many people in the world are encouraged that this looks like a 1 year kind of a issue rather than a longer issue that we are trying to look at. And so that's the positive news. With your second question, that you're right that almost 50% plus of all vaccines in the world are actually manufactured by India. So Indian guys, there are a couple of guys like a Serum Institute, or as well as Bharat Biotech, which are actually gunning for, trying to have clinical trials for these vaccines. But we're slightly behind the curve in the sense of, where we are in the clinical trials process. So our assessment is that India will take some time, or we'll have to partner with, one of these global guys to see that, how can we actually participate in coronavirus vaccine. But I'm sure that given the size of the manufacturing that we have, we will certainly have some kind of an play there in terms of how this can be done, in the overall sense that we're looking at.
Interesting. So at least in beginning of 2021, we can expect the COVID vaccine to kind of come up. And
yeah, fingers crossed. Yes, fingers crossed.
And hopefully from India itself. So that will be a proud moment for us. Great. So Dhaval, one another thing that I really remember is during NFO time, you really talked about that the pharma industry's evolution could be pretty much like IT industry's evolution that we saw in early 2000s. So we started at a low end of the value chain, just doing some application development, etc., and then the enterprise development on the IT side, and then the infra management, etc. And ultimately, I mean, we are all going digital, right? Quite a few of our leading companies are really transforming themselves into digital companies. So you made a case that even pharma industry really can undergo that kind of transformation in that the API or bulk drug to whether it's generics, simple generics, or complex generics, all the way to innovative drugs, pretty much including COVID vaccine. So you just made that point as a very Indian pharma being a very structural and secular growth story for India. Can you just talk a little bit more about it? I mean, 1 year out, 1 year from our NFO, where are we on that, and what kind of trends are you seeing in this evolution?
Sure. So it's a very interesting journey, and it's actually a journey that has started since 1980s. 80s, not many will remember now, but we were one of the large API manufacturers, and API is nothing but active pharma ingredient, which goes into the tablet, and which is the actual ingredient which actually cures you. So every API gets converted into a tablet and or a capsule or an injection that you eventually have. And we were large manufacturers there, but over a 10 to 20 year kind of a cycle, China became a cost leader. It was where the whole industry for API has got shifted to China. But we, based on our scientific pool of knowledge and our ability to scale manufacturing to global standards, migrated towards manufacturing large-scale tablets and capsules, and became a large formulation player. That we are today. Slowly and gradually after that came a phase which is the last 7-8 years of phase where we're trying to look at where, what we've done is we've actually become very good in manufacturing complex generics. And what is complex generics is largely, any injection, any ophthalmic solution which goes into your eye, or any patch which can come to your skin. These are all different ways in which, you can get medicated. And there is a high level of complexity because injection directly goes into the blood, and that is where it has to be, with that kind of an accuracy versus a tablet that you're trying to look at. And so that complexity is something that we were able to migrate. As soon as we migrate more towards a complex product, obviously the margins and the complexity increases, so the number of players reduce, and the overall margin delta for the overall business actually improves. Interestingly, from there on, today we are at the journey where complex generics is actually picking up as we speak today over the last 3-4 years that have happened, and that is a trend. And also there is an additional trend which is the next leg of growth, which is biosimilars. where whatever was the overall developments that happened on the chemistry side of the business, which has started since 60s till now. Last 50 years, we've seen a lot of chemicals which are helping us to cure a lot of medical ailments that we have. But now we are using biochemistry. Biochemistry are nothing but live biologics into the overall product, which can help you build proteins, and that can help you to
Can
solve.
you give some example, Dhaval, on this?
So, say a classic biosimilar is used for cancer treatment. Today, top dollars globally actually go in for finding R&D solutions for cancer, because that is one area, or oncology as it's called, is one area where we've not been able to find satisfactory solutions. And incidentally, a lot of biosimilar drugs are able to help us to cure a lot of these. So biologics is the original version, and biosimilar is a generic version of a biologic that we're trying to look at. These are all biochemistry. It's a combination of biology and chemistry in terms of the overall manufacturing that you're trying to look at. And there again, there are a few set of players which have the competencies to actually get in there, and it also requires a large investment. So if you were to develop a molecule for a developed market like US, a chemistry molecule, you have to spend $4-5 million, and you are able to get it from your R&D lab. But to develop a similar biosimilar molecule, you will have to spend upwards of $50 million and closer to $80-90 million to get one molecule out. So it just shows you the kind of complexity as well as the kind of time and capital investment that is required. At the same time, once you get it right, there is a long runway that you can actually enjoy, because you are one among the few who has actually got those products right into the market. And then finally, up the value chain, which eventually someday we hope we'll be able to go there, is all about trying to get into an innovative drug, which is actually done complete R&D in India, developed in India, and we are selling it to the world as a first innovative product based out of India. So that's the complete value chain we are actually traveling, which is, as you rightly said, similar to what IT did. What happens in this value chain is, as you move upwards, the profile of the business actually improves a lot in terms of the stickiness of the business. So, if you were a regular reader of Pharma, then you will see all the companies today, while in India is a supplier of 40% of the volumes in US. So every US citizen, whatever drug he is consuming, 1 out of 3 drugs, or actually more than that, is actually coming out of India, right? But now what we are trying to do there is not only get that scale, but now get into more complexity, which will the classic word used there is specialty. So we are getting into specialty generics, where we will be able to participate there, and get more stickiness in the revenues in terms of what we're trying to look at. And that is fairly interesting as a journey that we're trying to look at, and we find a lot of winners. So just to give you an example again, and you ask that what has changed in the last 12 months. India, there are, and again, whatever company names I'm giving you is just for an example's sake. These are not recommendations that we're trying to look at. So, say a company like Cipla and Lupin, they have been working on a respiratory franchise development, which is where, if you have a respiratory issue, then you can take an inhaler, where you just need to take a puff and it directly goes into your lungs, rather than it going to the stomach and then the medicine impacting eventually. That kind of it's a very complex device to actually operate and actually get an approval for, and there has been 4 to 5 years of R&D that has gone into it. Incidentally, in the last 6 months, Cipla has got the first ever respiratory approval that India has actually received. Lupin is gunning in the next 6 months that it will actually get there. So that again shows that we are moving up that complexity curve. Our investments over the last few years are now fructifying, and that will help us to build that franchise, be it respiratory, be it oncology, biosimilars, and in other areas that we're trying to look at. That should all be coming as we move forward.
Wonderful. So it's a great story, and a lot of developments we have already started seeing, and some of the examples that you have given are quite interesting. So great, Dhaval. So let's move on to the some of the growth drivers of the pharma industry, and particularly in the Indian context. I remember even again in NFO, and even post that, some of the conversations that we have had also with some of our partners here on the call. Is the 2 key drivers, if I remember right, growth drivers. One thing that you mentioned, that because of the kind of the awareness around the healthcare insurance, or the medical insurance really kind of increasing its penetration in India, the medical spend done on the pharma and the hospitals and the diagnostic, etc., has really gone up multifold. And with that, it really implies very strong, growth potential for pharma and healthcare industry. So can you just walk us through a little bit about that? And with COVID in the last 4 or 5 months, what does it mean? Of course, I mean, no one wants to really profit here from this kind of pandemic. But since it has already happened, what kind of impact do you see of this pandemic and the greater awareness among people, both for healthcare in general and health insurance in particular? So how do you see health insurance as a key driver of medical spend on pharma?
Sure. So let me simplify this for you. We
Yeah.
are earning around $2,000 per capita, right? 4% of that, which is approximately you can take $80, is something that we are typically spending per person in India on healthcare. Okay,
Mhm.
out of that 4%, 1.5% is actually spent by the government, and 2.5% is spent by individuals, right? Uh,
Mhm.
while we are used to in India that this is a norm where a majority of the spend is done by individuals and not by the government, it is exactly the opposite for a developed market. You go to any developed market, be it US, UK, and any other one, Japan, you will find invariably the actual spend on the overall healthcare increases as your per capita income increases, and there the number is closer to 10 percentage that you will spend as a percentage of the overall GDP on a per capita basis on healthcare. So we have some decent way to cover there in terms of what we're trying to spend on a per person basis. Secondly, a disproportionate percentage of that, is actually spent by the government. So in India, because of this crisis, and because we were overwhelmed in the last couple of months by the fact that we were inadequate in a lot of things, that be it from right from hospital beds to availability, of critical medicines that we're trying to look at, or essential APIs. Government had earlier a stated objective that from 1.5 percentage of GDP that we're trying to look at, this spend will go to 2.5 percentage by the year 2025. That is over the next 5-6 years, right?
Mhm.
Our assessment is that that will be front-ended now. A lot of spend by the government will actually be front-ended in terms of trying to create more capacity. Again, to give you a context, look at hospital beds, right? And that is where the crisis in COVID was. India has zero point 0.9 per thousand people in terms of the number of beds which are available. So
Mhm.
for the whole of population of India, which is 138 crore people, our total bed capacity is 12.5 lakh beds. Okay. And for a country like US, which is one third of our population, they also have 12.5 lakh beds. So that is 3 beds per thousand population. So ideally, we should be investing a lot in bed creation, right? And that is where now, and what are the problems there? Again, private sector, if you were to look at the largest private sector hospital today is Apollo Hospitals. They
Mhm.
have less than 8,000 beds out of that 12.5 lakh beds, right? And only 44 hospitals run throughout the country. Now,
Mhm.
we have actually covered quite a ground, because in 2000, the number of beds that Apollo Hospital had was 1,500, which has gone to 8,000, which is like around 5x kind of a number, right? In the last 20 years. And, the revenue has gone from 300 crores to 29 to 10,000 crores, but it is still, not even 1% of the overall pie that we are trying to look at in terms of the market share that, this guy has, which is the largest hospital chain that we're trying to look at in the private sector. So, there will be more impetus from the government to see that how private sector participation can actually improve, how government can allocate more availability of land and various other resources that is required to create an hospital infrastructure, so that, you are not overwhelmed when actual crises actually happen in that sense that you're trying to look at. That's one mega change. Second is that, government had already launched a very big program, which is known as the Ayushman Bharat
Ayushman
program,
Bharat, yeah.
right? And it is one of the most talked about program under Modi ji's regime, which is known as NHPS, which is the world's largest health insurance program, as and when it actually fructifies. The idea was fairly simple, but fairly insightful. That in India, around 40 to 50 crore people, and that is around 10.4 crores families, do not have any access to healthcare, because they do not have that kind of an income. So even if they fall sick, they have the money to go to hospital or take care of themselves. And government said that we will cover all of these guys for an overall insurance premium that government will pay out of the pocket. and each family will get a 5 lakh rupees cover. Now, this was launched, I think, around September 18, if my memory is right. And let's see what have we traveled till now. The total number of cards which are issued under this program, right, is somewhere around 12.5 crore people who have enrolled for this program. So our target is to go to 40-50 crore. 12.5 crore people have already enrolled in this program, right? 1 crore surgeries have already got done in this program till now. That means that anybody who did not have the money went to an hospital, inquired. They said that, look, this is a program. You enroll all your 5 family members and you get the surgery also done, and so that everybody is covered finally, right? And that is the journey that we've actually traveled till now. And that says that as the insurance coverage is actually improving, you will have that benefit coming to the whole healthcare system, right? Right from, so there are 23,000 hospitals which are which are doing, coverage under this program. 67% of them are private hospitals and 33% is only government. So which again clearly shows that private participation is there in such a large program that we were trying to look at. And at the same time, when all these guys are covered, they will not be completely covered irrespective of what you're trying to look at. So there will be some medicines which they will still be required to buy, which will be benefiting the pharma industry in terms of either pre-operation or post-operation, or how do you need to take care. Another example is, let's take any elective surgery. If a doctor comes and tells you that you need to get operated for cataract, for a typical low middle income guy, if it is not urgent, he will postpone the surgery if it is not covered under insurance, because it's a spend of 25,000 rupees. He will say, let me do after 6 months. But immediately, if he comes to know that 80 to 90% of the money is covered under insurance, he will say, let me get operated now. So a lot of elective surgeries like knee replacement, cataract surgeries, etc., get done, which improves the overall productivity also of the person who otherwise would have lived with that disease for some more time and not been as productive as you're trying to look at. So there are multiple repercussions in terms of what we are trying to look at. As insurance penetration improves, either be it through the government forums or through the private sector, you will invariably find the benefit actually coming out. India is again a very unique economy where 62% of the overall spend is out of pocket. And that can clearly come down as insurance improves. And, we can even look at daycare surgeries getting covered there. We can even look at OPDs. Like you have, some kind of a sickness, but you just want to go and visit the doctor. Today, there is no policy which is covering it. But there can, of course, be policies which can actually be covering that also in future. So that also is something which is a bright, future in terms of what we're trying to look at from an insurance perspective.
Okay. Quite an interesting perspective. In fact, what you mentioned is 2/3 of the hospitals are actually private hospitals. It's essentially another example, a beautiful example of public-private partnership, because it's a cause is social, but even if private sector is participating, they must be seeing some value even from the business perspective for all of them, so which is a wonderful example and much more scalable in that sense. Wonderful. So that really talks about the scalability or the growth prospect for these pharma industry and the hospital industry, as you rightly kind of pointed out. What about diagnostics? Would you like to just touch upon that before we move on to the next point on margin?
So again, you look at diagnostics, and it's always good to have a perspective of how various economies in the world have various industries placed, right? So as the global world has more of government involvement into healthcare, in diagnostics also there is one standout characteristic. India has more than 1 lakh diagnostic chains which operate in the whole of the country, right? China has 5,000 of them. Okay, and in US, 80% of the market is covered by 5 guys. So what
is very fragmented.
Yeah, so our industry is far more fragmented. Now, why is it so, and what will actually happen over the next 10 to 15 or 20 years is this, that you look at diagnostics, overall pie of the, so if I were to look at the overall healthcare pie, 68% is hospitals, around 13-14% is pharma, right? And whereas pharma gets far more attention when we talk of equity markets, but actually, that's how the overall pie is. And 6% of that is diagnostics. And so when I look at 6%, let me put that in numbers. It is close to $12 billion as an industry. Okay. Of that, 58% is which is known as pathology, where you take a blood test and get reports out. And balance is radiology, where you need to have high-tech machines which scan your body and try to get
CT scan and all of that.
Yeah, CT scan and all the other thing which is there, right? Now, this 1 lakh labs which are there are largely pathology labs, which operate in that 58% pie of that $12 billion pie that we're trying to look at, right? Within that, 50% market share is with mom and pop or standalone pathology centers, which is one guy who is a pathologist, he's opened his own shop and is working there, and is hoping that my children will join. If they don't join, then I will actually close down whatever I'm trying to operate at. 37% of the pie is by hospitals. So if you go into an hospital, invariably require some kind of a diagnostic with those. The balance 16% of that pie is something that there are only four guys which are the top regional or national guys which are actually operating in that pie. So be it Dr. Lal, Metropolis, Thyrocare, and things like that. And what will happen eventually is that a large part will get consolidated with these so-called regional stroke national players as they expand, and a lot of mom and pop shops will get consolidated in that. So not only is the diagnostics intensity, so say if it is 1 to 1.2 tests per capita versus a 10 to 12 which happens in the developed world, that will improve, but there is a big consolidation which will help a lot of these guys to keep on growing at faster rate of 15 to 17 percentage year on year. And that is where I think diagnostics is a fantastic business that you should be looking at. Many people get perturbed with valuations or with quarterly volatility in terms of what you're trying to look at. But our sense is that this is one business that you should be holding in for the next 5+ years and ideally 10 years to see that how much scale that these businesses actually get. And we are fairly excited on overall diagnostic space.
Wonderful. So the consolidation itself will throw a huge opportunity for some of the listed players and the large players in general.
Yes. Okay.
Wonderful. So the last question I had on the sector was, let me ask, because we are just running out of time and we want to cover a few other funds as well. So just on the sector side, one is the margin, because as you rightly said, every third drug or the medication being consumed in US is India manufactured. Now, if that is the case, then the politics and policies both have put huge pressure on the healthcare cost globally. And recently, we heard President Trump talk about the generics cost being very high in US and things like that. What do you think will be the impact on margins for pharma companies, particularly Indian pharma companies? And related two questions, I'll just ask on the sector, and which is the valuation, because last 1 year has been one of the, I think this pharma sector has been one of the best performing sectors in the industry. And I think the only investment which comes close to it is gold. So there's only two investments which have been very rewarding for investors in general. So what do you see as the potential? Was it just a compensation for the underperformance in previous year, or you really see that the pharma sector's outperformance will continue in the months, quarters, and years to come? So there's question number two. So one, margin, another valuation, and third is the earnings growth. So how do you see, because people are talking about now, GDP growing by 2-3% at least in this financial year, etc. What do you see is the impact on earnings growth for this entire space that we are talking about right now? So 3-4 questions.
Sure. So all of them are actually related, but let me take that one by one. First on overall margins that we are trying to look at for the industry, and if I were to talk very near term, and people are really excited by looking at all the pharma numbers today, that despite all the mayhem that has happened over the last 3 months where there was a lockdown, here is a sector which has not got impacted at all, be it in the top line. It's been fairly steady. Some have been -5, some have been +5, but nobody has actually lost much in terms of revenues, despite no marketing or nothing in terms of this promotional spend that you're trying to look at for the India business. And export has also improvised because India is now portrayed as a supplier of medicines to the world in terms of what you're trying to look at. So our assessment is that currently we are actually enjoying that sweet spot where there will be some good cushion on the margins because of the inability to actually do business in the overall lockdown environment. But at the same time, we would expect that this will normalize over the next couple of quarters in terms of the margin outlook that we are having versus the current quarter that we're trying to look at. But at the same time, if I were to look from a 3-5 year perspective, because of the first point of increasing complexity, and companies which are actually participating in that increasing complexity kind of a curve, you would find that there is certain delta to the overall margins, which will certainly accrue to many of these players. And importantly, a lot of large cap companies, say for example a Sun Pharma or a Lupin or a Cipla or a Reddy's, had actually made a lot of investments in that last cycle, which are actually will see the increase in revenues currently, and correspondingly, the improvement in the overall leverage and margins that we're trying to look at, which should continue from a 3 to 4 year kind of a perspective that we're trying to look at. And that is where we are constructive on the overall margin framework from a 3 to 4 year perspective. Though we think that current margins are something which will come down over the, it may sustain in Q2, but Q3 and Q4 it will come down, and then again it will see an uptick. That is number one. Number two, you asked on valuations and earnings growth. Let me first cover earnings growth and then come to valuations. So when we launched this fund, the primary hypothesis was that we had an approval even 2 years back, but we did not launch it for 1 full year because our ears to the ground always suggested that if 50% of the market is exports, that is not revived as yet. There were pain in the market, and that is where we did not launch the fund. When we launched the fund, we were able to see that a lot of export-oriented companies are saying that the business environment is actually improving, right? After COVID has happened, the business environment for them has actually improved further. So, I'm far more confident on the overall, earnings growth coming in now versus what I was 1 year back, largely because of the fact that, today, be it in terms of plant compliance issues, be it in terms of business demand, that everybody wants to keep some higher inventory for the fear that if there is some supply disruption, then you should not be caught at the wrong end. There is a certain business momentum which is favorable on the overall earnings growth that we're trying to look at. So that is where export is improving, domestic is steady in the overall sense of what we're trying to look at. So that were the two strong pillars, and which continues to stay as we are. And the third one is non-pharma healthcare is something where COVID has disrupted because of the fact that hospitals, not many people are going for elective surgeries, they are postponing. But I think that will all normalize over the next couple of quarters that we're trying to look at. So that should actually continue to grow. So overall earnings growth, there is a better visibility than where we were 1 year back. So that's point number two. Point number three, valuations.
So before you come to valuation part, so what kind of earnings growth does one expect in FY21 and FY22, for example? If you were to just kind of put a broad range of earnings growth for the sector.
For the sector, and overall earnings growth should be somewhere between 12 to 15% kind of a number.
That's very good. In FY21?
FY21 will be lower than that because of the overall disruption that we're trying to talk about. Will be sub 10% or around that kind of a number, but it will still be healthy. And post that, we are expecting 12 to 15% to sustain over the next 2 to 3 years. That is something that we're trying to look at, which will be above the overall nominal GDP growth rate for sure. That we're trying to project. Coming to the fourth one, where we actually launched the fund, was actually valuations then were around 20 to 25% lower than the long-term average. Clearly, we've seen that complete re-rating happening. And now today valuations are actually slightly above the long-term average, if I were to put it that way. So that valuation comfort is certainly not there. So today, if some investor is entering, then to enter that, I will buy any pharma stock and it will work. And that is what we were thumping the table. So what we were thumping the table 1 year back was, please invest in pharma, and you select anyone that you like, but you will actually make good money. Today we are saying that thing is ended. What we are saying is that now you need to be very cautious of what you are trying to buy in pharma in terms of the quality of the franchise, the outlook, where it is trying to go, and then see whether it makes sense, because valuations are slightly premium to long-term average in that context of what we're trying to look at, and we need to take cognizance of that fact. Now, what has happened is, if I were to look from a 2015 till 20 perspective, this sector was an underdog. So we had a weight of around 7% in the overall index, right, which went down to as low as 2.3% or 2.5%, at the bottom that we're trying to look at. Today we are back to 3.3 to 3.4%, right? Ideally, I think you will still be adding another 50% in terms of the overall sector weight from here on, and come somewhere around 4.5 to 5, even in a normalized environment. So I see this sector gaining a lot of attention from the overall index perspective. and a lot of money actually still wanting to get into pharma at every correction, if at all, as and when they get an opportunity, largely because the overall composition of profits in the overall index will actually be improving. And that is where, you will still find the money chasing, this overall index that we're trying to look at. But you have to be selective there because valuations are not today, in
As
your favor.
attractive as it was. Yeah,
Yeah,
got it.
but the outlook is still that, companies will continue to do better than the overall economy, and that is where people will continue to look at these stocks favorably. Of course, there are risks to the overall environment, and that is very important that we should always discuss that. That any export-oriented business is always having a primary risk that there can be plant compliance issues. It is not end of the day if you get a 483, you need to understand and read that form 483 is nothing but a form in which inspector comes and gives you an observation that these are the 4 areas that you need to work to see to it your plant is proper in terms of the overall compliance or CGMP practice, as it is called, which is good manufacturing practice. And companies actually invariably work, and it has happened over the last 20 years that you work and you come back and there is an exchange and you're all okay. But you need
It's
to
an audit observation which you need to attend to, and people
absolutely.
tend to attend to and kind of
Absolutely.
comply with
But
it.
those are some of the nuances of the sector that you need to take care of while you're investing. But the overall environment is fairly good in terms of the
Positive.
investment for pharma.
Interesting. So that leads me to the next question, and now let's talk about our pharma fund,
Yes.
both in terms of our portfolio composition that we have and few of the top holdings, and not as stock recommendations, etc. But which are the top holdings and what really what makes you feel that they deserve to be right at the top in our fund.
Sure. So let me attempt this in a different way. See, what we were doing 1 year back was we were saying that there is a sturdy domestic business, and there is a revival on an export business, and then there is non-pharma healthcare. These are the three pieces of the businesses that we are trying to actually invest in. But we will be disproportionately high in export business because there is a revival there, right? And we find that things will actually re-rate much more because there is no expectation of revival on the export side of the business, right? So any company which belongs there, which is a Cipla, Dr. Reddy's, Sun Pharma, is something that belong to a disproportionate part of the portfolio in terms of the overall allocation that we are trying to look at, right? So we had around 71 or 72% invested in pharma, balance 29 or 30 odd percentage invested in non-pharma healthcare, right? Out of that, almost 50% was invested in exports, and 21 percentage was invested in domestic oriented franchises. What we've done over the last few months is, as we've realized that export oriented franchises have actually seen that kind of a re-rating on the overall side, we have actually trimmed that and added more and more domestic businesses, and now we are equal in terms of the overall composition that we are trying to look at. And we think that that is a fair composition to have at the moment of where we are in terms of the overall valuation framework that we have. So we have increased our positions in various domestic oriented stocks over the last many months. Be it stock like Pfizer, Sanofi. We've added Abbott. We've actually taken our weights increase in Torrent Pharma, which is again a domestic oriented franchise, or an Alchem Laboratories, which is again a domestic oriented franchise largely. Where we think there is still very decent delta to the overall earnings versus the expectation that we're trying to look at. So that is the composition that we've actually changed there. On the non-pharma healthcare portion, we continue to actually have that steadiness where first 6 months of the fund we enjoyed disproportionate alpha because it did really well. But now in that last 3 months of pharma rally, it has actually lagged because of the fact that it was a pure pharma rally, and hospitals and things like that were not out of the woods, and that is why they're not participated. But we're not perturbed by that. We actually think that that will actually come back fairly well because they're growing faster than the overall pharma franchise, and that is where we continue to back them in the overall sense that we're trying to look at. That's the broad portfolio composition that we have for the fund. It's a fairly concentrated fund, still 23 holdings, which is there, and it will continue that way.
Okay. Wonderful, Dhaval. So I think my next question was actually around the performance part. So first of all, many congratulations and thank you for not allowing us to launch fund for the first year, that is 2018, 2019. And ultimately, I think we ended up launching in July 2019. So I think the timing was very, very good in terms of we captured almost the deepest part of the U-turn of this pharma sector really, and we had about 35,000 odd investors in NFO. So all these investors would have made good money, about 40% plus return. If they had invested anywhere else, obviously they would have made less than that unless they had invested in gold. But that said, that apart, I mean, dil mange more, right? So quite a few of our partners do have this observation, and they keep asking this question that yes, I think your timing of fund launch was very, very good. People have made money, those who participated in NFO, so that's wonderful. But on relative performance, when we evaluate ours compared to the peer group, it's a bit underwhelming performance. Partly you kind of talked about it, that they are a little more diversified in non-pharma space, etc. Hospitals, etc. did not do as well as pharma, mainstream pharma did, etc. But would you like to just kind of address our partners and some of our investors who might have participated on this call of what explains this piece and what can they expect in the future?
Sure. So I know this feeling very well because, it's like a classic Three Idiots movie, right? What makes a difference is that, what your neighbor or a friend has scored versus what you're scoring in terms of what you're trying to look at.
That's true.
Yeah, so, let me explain you, what has actually transpired. And, it is just a post-mortem, but it is, I think, it'll provide you some food for thought in terms of what we're trying to look at.
Right.
And I'll just use an example of a company which is there in the portfolio, which will help you to understand where we are coming from. There's a company that we're invested in, which is Zydus Wellness. Okay, it's a Cadila Group company. It has various products which are into the wellness category, which is classic non-pharma healthcare oriented ones. And the product that it has is sugar free. Almost a 90% market share in sugar free. So if anybody is consuming sugar free, you're basically buying that product. It has Ever Youth Scrub as another product, and again in that scrub category, it has a disproportionate market share that you're trying to look at. It has Neutralite, which is a substitute to butter, which is more healthier, and at the same time you actually get various other health benefits. It acquired a portfolio from Heinz, which is which has Complan, which has Nycil. Again, a disproportionate share of 62% in the market that it operates in. Complan is of course a lesser share because Horlicks is bigger there. And there's one more. So what happens is that we are fairly excited from a perspective. So when we invested into this company, it was at a price at which promoters also invested somewhere around that number. Incidentally, the fund was launched there, and we could clearly see that there's a lot of value to be made over the next 3-5 years. Immediately in the first 6 months, as things were running good, they hired a guy to actually oversee the overall operations, which was a professional. And in terms of, they merged all the supply chains, the distributors, and tried to say that, how can we save costs, how can we improve distribution network, etc., etc. Markets acknowledged, and it gave 50% return in the first 6 months of our investment, right? And we rejoiced. We had a disproportionate share, almost 5% of the portfolio, and correspondingly it benefited. Come COVID, Q4 and Q1 are the best quarters that the company has, right? And because COVID came in March and it survived till wherever, or it's surviving still, Q4 as well as Q1 got rogered, and the stock price again came back to the price at which we actually bought. Meanwhile, a lot of investments on the pharma side got benefited because of the fact that, pharma was under a general rally, etc., etc. Now, what we monitor more than the overall performance is how the company is doing and whether the company is on its right track. And you could clearly see after our interactions with the management, even otherwise, and now their quarterly results are also out, that company is doing everything it takes. In fact, from January till now, it has done actually 6 launches. Say in Complan, they've launched a Complan NutriGrow, which is completely focused on 2 to 6-year-old children. In Neutralite, they've actually launched a chocolate spread, which has proteins inside or calciums inside, which every mother will be willingly giving because of the fact that there is a Kiona which gives you protein. Right. They're all launching products which is into the framework of FMCG plus wellness, and which is where we think it creates a lot of value eventually that will actually happen. But for now, it is underperforming on the overall context of what we're trying to look at. Are we perturbed? Frankly, no. I don't want to be the fastest driver and give you the best number out there in a 1-year time frame and say that, look, I've achieved my number 1 position. I want to be fairly confident of the quality of the portfolio that I'm owning and the quality of stocks that we are invested into, which will give us a very reasonable return where we are thinking that we are able to do justice to the investor money that we're trying to look at. And that framework it might happen at particular point in time. I don't expect a 50% euphoric rally in pharma to,
Mhm.
happen time and again in that sense in terms of what you're trying to look at. So,
Right.
our allocation to that non-pharma healthcare is something
Mhm.
which has actually not worked. Our hospital stocks, which were again creating alpha for the first 9 months, over the
Mhm.
last 3 months, because they have very high operating leverage. Their occupancy fell from 68% to as low as 28% in the month of April, and now is back to 43, 44%.
Mhm.
So the stocks came back to the price at which we bought, and now they've again started going up in terms of what we're trying to look at. But
Mhm.
frankly, what we monitor is what is the progress and what is the management doing in the times of crisis, and how are they trying to handle the overall business. And we find all the right vibes. So we are fairly confident that that portion of the portfolio which is not participated in the rally will
Mhm.
eventually do. It's a time frame that differs in terms of what we're trying to look at, and we certainly think that that will outperform the overall index over the medium term that we're trying to look at. And that is where we continue to hold that confidence, and we will continue to be invested there. And
Perfect.
and we are fairly confident that we will be able to actually generate that extra return that we're trying to look at from those investments. It's only a
Mhm.
matter of time that we actually participate from those investments that we're trying to look at. So that's the broad level view in terms of what
Yeah,
we're
I
trying to
think
look
it's
at.
quite interesting, and very well explained both.
Sure, sure. Thank you.
Sorry.
So, yeah, so that is something which is there. We're fairly cognizant of what we are doing, what the market is doing, and we continue to monitor. In fact, we have one of the best investment committees which actually monitors every fund manager's performance on a regular basis, and discusses what is happening, what not. So what I can assure you is that there is a lot of hard work and process to it, and you will see the results of that in due course.
Wonderful, wonderful. That's quite reassuring, and with some very sound logic. So thank you, Dhaval, for that. I'm sure all our partners would have really got a dose of confidence of why holding on to it at this point in time really makes a lot of sense. So thanks for that. Now that brings me to another fund level question, and which is for all our partners who might not be aware or might have kind of noticed. Dhaval has started co-managing three of our hybrid funds, which includes equity hybrid 95, regular savings fund, and equity savings fund. Since the last 3 months or so, we have started seeing some good improvement as well in terms of there's a good uptake. What kind of portfolio changes you have made, and would you like to just touch upon the asset allocation that you have done? And in very brief, if you can also talk about why. So, for example, our equity hybrid 95 was between 75 to 80% allocation to equity, etc. So, what really gives that confidence right now? Because if you see, there is sort of a divergence between or the divergence between equity market and the flows. So the days when we see equity markets going up, actually we see more redemptions, and when the markets kind of correct, we see fresh purchases. So that's an industry-wide phenomena, between in terms of the negative correlation between flows and equity market movement on a daily basis. So how do you how because a lot of our partners are really having this question of whether to invest in this market. I mean, 30p now, price to earnings on a trailing basis for Nifty. Now there is a very historical level of price to earnings. Should we really increase equity allocation at this level, or should people start taking some this thing? So in that context, if you can just talk about your approach to asset allocation in all these three hybrid funds, and where are we? What are the key changes that you have made in this all the three portfolios?
Sure. So let me take that one by one. There are a lot of sub questions into it in terms of what we're trying to look at. First is that a clarification. 95 fund is something that I was co-managing with our CIO Mahesh Patil for some time, and there has been a change that now Satya is also managing that. In terms of co-managing that fund along with me, and MIP and regular savings fund is something that I have got added along with Satya to manage that. So first is. On the overall fund changes, what all we have done on the 95 side, and then I'll possibly look at the other two funds. 95 had a tough time over the previous 2 years, and we're actually now having last 3 good months, and we hope to continue that run into what we're trying to look at. So 2019, the performance actually got impacted largely because of the fact that we had disproportionate higher allocation of mid caps. And mid caps rally is something that petered out very early on, versus then what the large caps actually collapsed in the last COVID crisis that we're trying to look at, and that is what actually hurt the overall performance on 2019. while we restructured that on the equity side and recouped that performance a lot in terms of last year that we're trying to look at, which is 2020, FY 2020 that we're trying to look at. There was a hit that we actually took on the debt side of the portfolio, which led to that kind of an underperformance, which continued for 2 years. That is there. Now, what have we done on the equity side? In terms of what we're trying to look at is, our orientation is something that earlier where we were trying to look at higher proportion to mid caps and as well as orientation towards value is something that we've actually changed into a growth orientation in terms of trying to say that this portfolio A was very diversified with 72, 73 odd stocks. We are now reducing that diversification and improving the overall concentration of the portfolio. We have already reached to a number of 62 stocks, and our intention is to go towards 55 stocks to be held on the equity side of the portfolio that we are trying to look at. Secondly, we were more value oriented in the sense that we were holding a lot of stocks where there was value, but which was not getting rewarded. Now we've actually changed that style, and which is where we have aligned our overall fund management style more towards an advantage fund style, where it is more growth oriented, and that is where we've added a stocks which have that kind of an orientation. So, say for example, we participated well in Reliance Industries in the last complete up move that actually happened. We built up a sizable position in that in terms of what we're trying to look at. We are overweight banking, in the overall portfolio, specifically private sector banks, which is done reasonably well in that context of what we're trying to look at. On the consumer discretionary side, we have stocks like Whirlpool, Voltas, which have actually done reasonably well. On the FMCG side, we've added Britannia, which is again done well. So these are some of the stocks that which has actually helped us in terms of recouping the overall performance, and we hope that we continue to actually do that on a continuous basis and get to an overall improved performance in the fund that we're trying to look at. So that's what we've actually done in the overall context. The other two funds which are there, which is MIP and regular savings, are actually far more concentrated. They have only 38 stocks, 38 to 40 stocks in the overall portfolio, but their allocation to equity, so regular savings is 25% and equity savings is 45%. That we're actually running. Also in 95, one more important change that we've done is earlier we used to run somewhere at around 70% kind of an allocation. Since we've been bullish on equity, we've actually graduated towards 78% kind of an allocation, and going to as much as we can towards that 80% kind of a number. And that is where we think that various asset allocation products, wherever is the maximum available leeway to participate in equities, because we are fairly constructive on the market, is something that we'll continue to do from here on, and that should benefit the overall performance that we're trying to look at. So those are the few changes. My only humble request or suggestion to a lot of guys who are recommending these hybrid products to investors is that it is not that any one fund is superior to others in terms of the overall mix that you're trying to look at, but it is all about investors appetite of risk that he's wanting to take, and then deciding in terms of which is a suitable fund. Historically, it has been seen that anybody who wants equity participation but with low volatility, should ideally be looking at a hybrid fund with 75 to 80% kind of an allocation. Because now we have a 20-year history with ourselves itself, when it was launched in 1995, and we are in 2020 today, so 25-year history that we're trying to look at, where in all the down cycles, it should actually help in terms of the debt will actually come into your protection, and otherwise you'll get an equity-like participation, be it from a 5, 7, 10-year kind of a perspective that you're trying to look at. And that is something that will be a good equity participative product for a risk-averse guy that we're trying to look at.
Fair enough. So thank you for that quite an exhaustive answers for all the 3 points. In fact, I'm just seeing the questions, quite a few questions, whether it's around performance, portfolio, the valuation, all of those questions are answered. Some of the questions are now around some of the other funds. So my request to all our viewers here on this platform is that we will be eventually having all fund managers and CIOs to come over and kind of speak to you for each of the funds over the next many weeks. In fact, this is one initiative we intend to continue as an open-ended initiative, meaning every week on Wednesday from 4 to 5, we intend to present you one of the experts, internal or external. Uh, uh, they'll kind of share their inputs around markets, economy, and most importantly, products, so that you can refine and refresh your advisory accordingly. So let me take a couple of questions which we have not answered so far, or not answered completely rather. So one question is asked by Deepu, I think mastermind entity. That there are two questions by the way. Well, first is Nifty Pharma fund is up 40% on 1 year return. As Pharma is the defensive segment and caught a bid because of the coronavirus crisis, was up only around 10% pre-crisis, now up 40% up. Is the pharma sector overheated at the moment? And if you are looking to make the lump sum investment, should we wait for a better entry point? So I think you broadly touched upon it when you talked about valuation being a little higher than the long-term average. But you just wanted to touch upon it because you also mentioned that the weight could really go up from here by 50%.
Yeah, so our assessment is that you're right that you've seen a euphoric rally from 23rd March till date in terms of what pharma could actually deliver, and to that extent, what has happened is that people who are managing money were completely surprised by the fact that when we look at the numbers, there was an improvement in margin despite sales not picking up. And that was largely because the promotion expense were actually not happening on the India side of the business, and there was a gross margin improvement, which was because of the forex benefit that they actually got for export-oriented businesses. So yes, it is quite possible that this overall good rally might see some kind of a correction. But at the same time, we don't think that this is the peak of the sector, or we are done here, and we should actually be packing up and going home and not investing in pharma at all. In fact, we think that from 2015 till now, we've only been able to recoup whatever the performance actually had gone down. So 15 to almost 19, it was a one-way downside market for pharma. And it is only now that we've actually seen that kind of an performance where we've actually recouped the last 4 years of performance. Because the base businesses are doing well, we think that companies from here should compound at a rate at which their earnings are compounding, which is somewhere at around 12 to 15% kind of a number that we are projecting over the next couple of years. So that is the kind of a compounding that we're expecting from here on for the overall sector.
And related question, Dhaval, Mr. Narendra is asking with respect to valuations of pharma companies, its overvalued zone currently, how much can be allocated towards pharma funds? So essentially, percentage allocation, remaining part you have already answered.
Yeah. So, first principles first, any thematic fund, okay, is something that you should not be allocating more than 10 to 15% of the money. If the investor you think is suitable to have that extra allocation to the thematic fund. So be it our banking fund, be it any other fund that you're trying to look at, any theme-based fund, ideal allocation should be somewhere at around 10 to 15% of the overall equity money that you are trying to look at. And I would think that that is where this allocation should be capped. Within that, I think pharma still warrants investment, largely because we still have a very constructive outlook on pharma over the next 3 to 5 year perspective.
Fair enough. I think that's fair. Now, last question we'll take before we sum up is from Mr. Prashant Parekh. He is a bit concerned about hybrid equity performance. He's asked, my question is about ABSL hybrid equity fund. It is performing at the bottom of the peer group from 6 months to 3 years. And then he has kind of given returns. So what's your view? I think you broadly covered that part. But on the fixed income side, where we had some hit, would you like to give some guidance as to what can people expect what's the kind of prospect over the next 2-3 years? While we have started seeing he himself has mentioned that 6 to 3 year performance is not looking good. I think last 2-3-4 month performance has started seeing some uptick. But what's the prognosis? What's the kind of outlook?
What we've internally looked at is two things. One is on the equity side, what we need to do to improve the overall performance, and I walked you through that in terms of what all changes we've done. And we think we are on the right track purely because of the fact that since the time that we've done the changes, we are actually seeing that is actually working well, and the near-term performance is indicative of that. Second is that, on the debt side, we have actually written off, one large security, where, the regular payments that are actually happening from the issuer is still, going on well. But as a matter of prudence, based on the overall rating
Rating.
that we've actually got, we had to actually write that performance off, and we are kind of hopeful that we will eventually be able to recover those investments. And if that were to happen, then you will see tables turning fairly quickly. There is no assurance as to when that can happen, or when such an event can actually happen, but we are hopeful that if that happens, then things can actually materially improve from that end also, and contribute to the overall fund performance. Otherwise, on the debt side, we are running a fairly good yield, and that should keep on accruing to the overall fund. And we don't feel that there is any further hit that will actually happen on the debt side of the portfolio as we speak today. And that is where we're fairly confident that things should actually improve from here on, in the next 9 to 12 months for the overall fund.
Fair enough. I think just to kind of reinforce the last point that you talked about, the fixed income security, the exposure to which, if kind of materializes, because that underlying security is performing well in terms of its servicing of debt to other mutual funds as well as to our mutual fund. It's just that when our money is due, with if the money comes back, that could be a significant upside for the existing investors of the portfolio. So that's something for all our equity hybrid 95 investors to kind of note, and to kind of keep watching for that payout and event. While the equity part of the portfolio has kind of turned around, we have started seeing good improvement on that. Dhaval spoke about it in detail in terms of what changes he has made in terms of sectors, asset allocation, as well as some of the companies or the capitalization essentially. So keep watching this space, and hopefully the next 9 to 12 months, as Dhaval mentioned, we should be able to deliver you greater performance in equity hybrid 95. So lastly, Dhaval, just to kind of sum up, we are very, I think, just kind of overshooting the time. Just before you kind of have your final words of kind of advice to our partners and investors on the call today, what I heard you say was that we kind of the worst for pharma as a sector is over last year. It has started kind of doing well. The P re-rating has already happened. You expect the earnings growth to kind of continue to be much better than, in fact, if it is 10%, even this year is going to be much better than the nominal GDP growth itself. In FY22, you are expecting 12 to 15% earnings growth in that. You also expect the sector weight to kind of go up by 50% from 3.5 or something you mentioned. 7% is still far away, which we have already seen 5-6 years back. So I think the prospects point of it looks like earnings growth is well in place. There is an upside in terms of further weight improvement, etc. But also you mentioned that the valuation point of view is slightly above for long-term average, and therefore it's now a stock picking kind of, we are into stock picking zone, and one has to be really careful about it. You also talked about the fact that sector, the asset allocation of investor towards sector should not be more than 10-15%, and that, by the way, includes all sectors put together. So really, you have to have a very prudent approach in terms of asset allocation, because we all know that ultimately long-term wealth creation depends more on asset allocation than on security selection or even fund selection, arguably. So asset allocation is the most important part, and Dhaval's guidance is that not more than 10-15% of investors' portfolio should be in sector funds all put together. So that's what I heard you say, Dhaval. Thank you very much for all your insights. And final a few words and few lines from you as departing message to all our viewers today.
Well, you summed it well. The only thing is, and I actually written about this even in April newsletter for our pharma investors. And at that time, situations were looking very bleak, and I can vividly remember that you had everywhere written that this is the fastest ever fall that we have witnessed in the history of world markets. In 19 days, you are into a bear market, which is what we're trying to look at. And we had only mentioned two important points, which I want to reiterate at that point in time, and which I want to reiterate even now, is that, first is that, in this era, while we all follow news and views very, very closely, what is more important is to actually have more confidence on the kind of companies that we are actually invested into. And we had actually called out then that we will not be surprised if the pullback is also as sharp as the fall, and at that point in time, which incidentally has panned out. And we've seen, I think, one of the fastest ever pullbacks also out of a bear market rally that we're trying to look at. So that's very important in terms of trying to say that please don't try to time the overall market and think that we will be able to make money out of it. It is always been that a prudent asset allocation has actually helped in the overall context of what we are trying to look at. Second important point which I want to highlight is the fact that look, this is a recession which is actually caused by an event, which is a particular event. And while 3 months back we did not have clarity on the overall context of how long can that last, and we were all overwhelmed by the fact that how do we address this. Today, there is a proper protocol that you should be home quarantined if at all you're getting this at early stages, and then what are the kind of medicines that you will get. If you get hospitalized, what are the kind of medicines that you get. If you get into ventilation, what are the kind of medicine that you get. And the fact that there will be some or the other solution by the end of this year, or end of this financial year, if at all, that we're trying to look at. That means normalization will happen by F22. But by the way, there has been so much money which has got printed in the name of COVID worldwide, that you will find unprecedented rally, across all long duration assets. So, I am fairly constructive on the overall equity market framework, and I will encourage all investors to look at equity markets fairly favorably in that framework, because the event will be, past you in the next couple of quarters, and you will have unprecedented money chasing that, and which means that you need to be invested into any asset class which is long duration, and equities is the longest one. So that is where I would think that you should be participating.
Thank you very much, Dhaval. On that optimistic note, thank you very much to you and all our viewers today. Blessed to remind all of you, next week at the same time at 4 o'clock on Wednesday, we'll be back with you with another analyst. This time we'll be having Kunal Sangoy, who is an analyst for our IT, telecom, and media sector. And he also happens to is our digital fund manager, EBSL Digital Fund. So look forward to have you join us once again on next Wednesday at 4 o'clock. Thank you very much and do take care. Thank you.